Hey everybody, Dave Bartosiak here with Zax.com, and I've got another chart of the day for you. This time it's Oracle, ticker ORCL, and pretty impressive stuff here. So they just had earnings last night, a beat on the top and the bottom line with a guide higher for next quarter, but that's not even the most impressive part. Okay, I had to zoom out and just behold the move. I mean, the whole decade, right? Just incredible stuff. And a company like this, I mean, they've had their retracements, right? Had these pullbacks on occasion. Some of them pretty dramatic, right? But that just goes to show that if you're in it for the long term and you're in a good stock, solid fundamentals, earnings are moving in the right direction, sticking with it can really pay off a lot. Gonna zoom in a little closer here because nobody really cares about what happened in 2011. But what's more relevant is these gaps, and you get a ton of them. It seems like this stock is just prone to gapping, and we're gapping again here. But one thing I'm going to have to point out here is these gaps typically get filled, okay? So even going back to this 2023 gap, get the big gap up, and then what happens is it's slowly, you get another gap, but that way down, but it ends up getting filled, okay? And then we had another gap, and that gap got filled, and another gap, and that gap got filled. So even when they have these monster reactions to earnings, doesn't mean it's going straight up, despite the chart going straight up, right? These gaps get filled. So I want you to think about that when you're looking at a stock like this on a day like today. Is this time going to be different? Is this a gap that doesn't get filled? No. This gap's going to get filled, okay, eventually. Now, are we going to have a little bit more of a run-up before it does? And how long does that run-up last? That's the million-dollar question, right? So just be wary of, looking at a stock like this, seeing a good report, and then just jumping on board. Now, you can if you're a long-term person, right? It doesn't matter. If you're a long-term investor, you don't really care what the price is today. You're worried about what the price is 5-10 years from now. So, yes, the gap's going to get filled, but you don't care, right? So it probably makes a pretty good case for dollar cost averaging, things like that, right? If you're going to buy into the stock over the next couple of months or quarters or weeks or whatever, right? Okay. Now, here's the problem with a chart like this, because when you go into this uncharted territory, it's hard to really do any sort of real analysis, right? So, and what I mean by that is we can draw, Fibonacci extensions off of some of these moves and get an idea of where, the top side might be, but it's not as concrete as when you're, looking at a move and then it comes back and it fills this stuff, right? So this is what I mean. Like, if you take a look at this last move off of the 200-day moving average, right? And you see stock runs out of steam, comes back, retraced. In this case, you had a gap to fill that happened to coincide with the 61.8% retracement of that move. So there was support there, and now it's moving higher. So we can use that most recent area or most recent fib to gauge where it might go. So if you check this out. So these are fib extensions, or these are retracements. These are extensions, right? And I just drew this upside down because I was, your standard tool is going to allow for this. So if you think about this in terms of this being, one range, right? Then 61.8% of that one range is up here, this 166.93. So that's the 61.8% extension off of this move. So given that it came down and hit 61.8% retracement of that. It's going higher. Now, I know a couple of people are going to go, hey, wait a minute, this says 38 too. Remember, I drew this upside down. Yes, I know I just confused everybody, but sorry. It's just, I can format this tool so it'll make more sense. But just doing this quickly, I just wanted to show that I inverted this, so these numbers just got flipped. But anyway, so if you catch the 61.8 this way, the target should be the 61.8 going in the opposite direction. So that's kind of short-term top-end target for that, right? That's one way to look at it. And that's I guess that's the number that I'm going to throw out there. Stock ran into some trouble at 160 earlier today, right? We're not going to put too much weight in these intraday moves following earnings because, as you can see, had these monster moves and then they kind of stall out. So a few days later, they kind of stall out. So we've seen this happen in Oracle before. So that sort of 166 level is something to keep an eye on. If the stock keeps creeping on up, that might be an area where you're going to see some supply enter the market, maybe another pullback. The really long-term patient people can set an alert, literally just set an alert for this gap getting filled on Oracle. I don't know if it happens in a day. Well, it's not going to happen in a day, but a week, a month, a quarter. Eventually, it feels like these all end up getting filled, right? Last time, it took a while, right? Got the news in June, and we really didn't get filled until August. So a couple months there before that happened. So that's something to keep an eye on for Oracle, but still a great quarter and a great reaction to the report. All right, folks, there you have it. That's my chart of the day. Tomorrow, who knows what chart I'll bring to the table. I'll make that decision tonight when I'm looking at things, but very interesting stuff, I think, moving forward. Plus, we've got the CPI tomorrow morning, which is obviously going to be a huge risk event for markets, and we'll see what happens. So for everybody here at Zacks.com, I'm Dave Bartosiak. I'll say thank you, and we'll see you tomorrow.